Hi friends from around the world, how are you today? Now, if you cannot rely on what you have received in instructions in school, on what can you rely if you want to build little by little your financial freedom? So today's lesson and the next video, this will be one of the most important lessons perhaps in your lifetime. If I would have seen this lesson, if I was in my 30s or so, I would be much better off today in my financial management. I'm okay, so I have no problems, but I think I would be much better off if I would have received this instruction today. So if you are in your 30s today and you listen to what you will hear now and in the next video, I think you will be able to make a big leap in your financial adventures in the future. I repeat, this is not financial advice. I give you the background, the foundation, so that you can build what would be your financial investment in the future. So you need basic skills in order for your future adventures, investments, wealth management, whatever it is, to develop. You need this to know. Now let's start by very easy and light and simple things. You have your basic necessities covered, so eating, shelter and food, and that is okay. And then what you have with the rest of the money, and even with the money which is in the basic, you are doing an investment or you are simply consuming. These are two different things. And it's a gray zone, what is one and what is the other. Now, consumption is for your immediate pleasure in general. So you want to go to a cinema, you want to take a coffee, you want, I don't know, a game, to make a game, to play a game on the internet, or you want to go out in an expensive restaurant. This is consumption. Normally it is consumption. It is consumption because it is for your immediate delight, for your pleasure, for your distraction, for your entertainment. So it gives you pleasure in that moment, right? And that's okay. So why not? Why shouldn't you have some pleasure during the day? Consumption is also normally an expensive car. That would be consumption, immediate pleasure, but there is no what you would think is return of investment. So I'm coming to investment now. Consumption is immediate pleasure. Investment would be more longer term. It could be short term as well, but more longer term normally return of investment. You put money onto the table, 100 of any unit of account you may use, and you want to have 110, 120, 200, 300, whatever it is, you want that back. And then you compare one and the other. You have a difference between the investment and the return. So that is your gain. So it is not for your entertainment. It is not for your pleasure. It is for making money, so to say, for a return of what is your capital, which you have put at risk. So is that clear to you? Consumption and investment. So there's a gray area I would like to mention, which is, for example, a cup of coffee or that expensive restaurant where you have been with somebody. So if it is, for example, you take your Starbucks coffee for what, $5, $4, whatever it is, every day on your own, though that is simply consumption. if you want to go to a Starbucks or to that expensive restaurant in order to meet somebody with whom to get into some kind of negotiations, deal, investment, business, whatever it is, then it could be, in fact, investment. So the same thing might change in one or the other. And in general, well, consumption is money lost, so to say, and investment is the hope for a certain return and to make more money, to receive more money back. And what my point here is, you make on a daily basis your decision on whether I want to consumption, or I want to invest. It's a daily, and we will see it with some examples. Now, with regard to investment, let us go a bit more in investment. You have a yield, right? A yield would be what you want to obtain to return, to have return back. So you want ideally, I don't know, 100% perhaps, or 200%, 300%. That would be the yield you would receive back. So you put 100, you have a yield of 200%, you would receive 300 of that unit on account back, right? So that is a yield. Second issue is the time. So if it is an investment which is for, I don't know, 1 day, you would have it the next day, right? If it is for 1 year, you would have to wait a year in order to get the yield, to get the return of investment back, okay? Inflation. Inflation is another issue. Inflation is, it is a kind of tax from the government, but which is hidden. They tell you inclusively that inflation is good. On my opinion, inflation is not good, but well, be it as it is. So inflation is taking money away from you. If inflation is, some 20%, then in 5 years, what is left? You tell me, what is left? Well, nearly nothing, right? So inflation is something which you have to take into account with regard to the yield. Because if you have a 100% yield and with 20% inflation over 1 year timeline, then you have 20% less, and you have to deduct this 20% from your yield in order to get to your net return. Okay? Now, the next issue is risk, and that is an important issue. Risk is when you put money on a table, right? You would say that the risk can be high, can be low, but there's always some kind of risk. If you want to get something in return, more in return, so there must be a kind of risk in the middle. Now, these are the 4 issues you would need to know with regard to investment. The yield, the timeline when you get the return, then the inflation and the risk. Now, how to mix that? When you get to the mix of these 4 factors, and that is an important issue. Let us take an example of some stamps. Stamps, you know, the stamps on the letters. You know, you don't make letters anymore, but there were some stamps on the letters you have written in the past, probably, and they tell you, well, these are rare stamps from, I don't know, from China, for example. Rare stamps, they are not anymore made, and people, they're collectibles, and people get ready for these collectibles, and they want it. So I give you a piece of paper that you own, I don't know, 10 stamps or 1% of the overall stamps collection, whatever it is. Here's the paper, and you give me 100 of any unit and account for it. But knowing that, stamps are scarce, so there's no anything which can be reprint because there's a stamp on and, whatever it is. And people want to have these collectibles, and it will go up in price. and it has gone up in the last 2 years by a factor of, I don't know, 0.5, for example, 50%. Okay? Now, how would you approach this kind of wealth investment, which is investment proposal, so to say, to you? Well, you would probably go, and often you should go, to look to the risk side. Rather than going to yield and time, etc., going to the risk side. And the risk, what does it entail here? The risk would be, for example, what is the liquidity? What is the possibility that my paper I can at any moment when to go to whoever it is in order to get my money back, or to get at least the money at what the stamps are valued at this moment. What is the stop loss, so to say, I would carry, I would entail? So there's always something loss in investment. That is something normal. You have to get used to it. That is possible at any moment. But how many can you bear to lose at this moment? So is it 10%, 20%, 40%? What is your mindset able to lose? Even if it is on paper, right? But it may go up in the future, but the emotions are in the middle. I will go into emotions in some other video, but here you need to know where is your break even, or you say, well, I will go to that point. Or what is it if you hear that the market has gone down 50%? Where are you? What is the possibility to redeem the paper in order to avoid further loss? So these are risk management considerations which you should go into very, very deeply, because the winning they will take care of on their own, but it must be in your game plan as well. But the downside, that is you in control. You are in control of the downside. You are not so much in control on the upside, but on the downside you are in control. You need to know when to sell. That is important. So you want to have preservation of capital as one of the first things you should always think of. Now, this is for the risk. I don't want to extend much more here. In the next video, I go through some other examples, and we go to the compound interest and to holy grail of investment. But this is a necessary foundation for the next video. Thank you for being with me today.